So let's take 10 and talk about where institutional investors are putting their money today. When thinking about this topic, it reminds me of the story about Wayne Gretzky. He's been asked countless years about what made him so good at the game of hockey. And his response was always, I'm focused on skating to where the puck is going as opposed to where the puck is.
The GOAT.
Exactly. And, in my mind, thinking about large institutional investors, it's the same thing. They're thinking about where should we be invested going forward as opposed to making their investment decisions in the rearview mirror.
Yeah, well, I want to welcome back our guest, Nick Rosenthal with Griffin Capital. Thanks for being here with us today.
Yeah, great to be here.
We've been working with Griffin for quite some time now, and you guys actually have a very interesting institutional pedigree on your, I believe it's your board. Dave Rupert, who's actually spoken at one of our summits in the past, sits on the Cornell Endowment, right? So if we want to talk about what are institutions doing, the endowments, I think, are a great place to start, as well as the pension plans. Kind of give us an idea of where your company's positioned and where you see what we call the smart money kind of flowing.
Sure. So, I prefer Bobby Orr as a Boston Bruins fan over Wayne Gretzky. But I think when we think about what are investors doing, certainly they're looking to solve the challenges that are being presented by a very low interest rate environment. So not that different than investors that are kind of entering the retirement phase of sort of their financial planning path. Institutional investors have liabilities on an ongoing basis. So they value slow and steady portfolio growth, but also stability and the ability to address those liabilities in a very consistent way, generally through heavy allocations to things like core bonds or sovereign debt, which in general, historically, have been very low risk propositions relative equities. But there's this challenge that these institutional investors are trying to address, and that's that effectively there's increasing correlation between traditional fixed income and growth equities in their portfolio as a function of the risk of interest rates rising. So interest rates rising is going to be bad for traditional fixed income. We saw that in the first quarter of this year, and it's going to be bad for growth equities. So now you have something that's supposed to protect you, right, that's bad for two large parts of your portfolio. So what do you do?
Right. We like to pay attention to BlackRock capital market assumptions, right? And so one of the things that they've put out for fixed income, traditional fixed income, over the next 5 years is the anticipation somewhere between 0 and 1% on an annualized basis, right? So if I'm a regular investor and I'm in a 60-40 portfolio, so 60% in equities, 40% in fixed income is typically where we find a lot of people when they come to us. If 40% is doing between 0 and 1, I've got a humongous issue on my hands in that I'm probably not going to get the type of returns that I was anticipating. So the institutions out there are going through this same experience. Where are they going?
Right. And you've got the backdrop of unprecedented monetary and fiscal policy, right, which investors fear is going to drive inflationary pressures. So when you look at financial assets that historically generate diversifying sources of return relative to traditional fixed income and equities, but also generate yield and also correlate positively to inflation, it's alternative investments like credit and like real estate. So what we see is a lot of institutional investors adding to their credit allocations. So credit is typically floating rate loans to below investment grade companies, whether they're directly originated or they're in the bank loan space. And in periods where we see inflationary pressures, bank loans and direct lending, private credit have outperformed traditional fixed income. So have high yield bonds. And the reason why this alternative credit bucket does well historically in this environment has been duration is shorter, right? And what you're trading as an investor is duration risk for credit risk. But if you're entering a period where the economy is expanding, that's supportive for businesses, so you have lower defaults, and therefore it makes sense to take a little bit more credit risk if you can reduce duration risk. So what we see a lot of investors doing is investing in this alternative credit space where they're getting higher yields than traditional fixed income with lower duration. And they're picking managers that historically are able to navigate credit selection with very low default rates.
I think it's important that investors in that particular space are able to invest across the broad spectrum of what credit means, right? Because most people when we think of credit and you're a retail investor, it's like, well, I can only really invest in a bond mutual fund, right? Like I don't have access to these things that you're talking
Sure.
about. So can you kind of give us an example of what those different types of credit look like
Yeah.
and kind of how they differentiate from each other?
Yeah. So when we think of alternative credit, it's that middle market direct lending piece, which are loans to privately held companies. Privately held companies are a huge part of the underlying economy, actually much larger than publicly traded companies. So you're getting a lot of diversification in the underlying companies to which you're exposed. But those loans are typically structured as floating rate loans with floors. So as interest rates go up, obviously the borrowing costs go up for the borrower, but in theory, in that environment, their business is also improving, so they can meet those obligations. But as an investor, you're not losing purchasing power like you are with a fixed rate instrument, right? So as rates are going up, your receivable, the interest that you're getting, is also going up, which is why you mitigate that duration risk issue in that space. Bank loans are the same structure except to publicly traded companies, and they're more liquid in nature. The idea of active management in this space, right, is really what you're getting at, which is the ability for a manager to say, does it make sense, given sort of the risk return environment, to be more heavily invested in private companies or public companies, fixed rate securities or floating rate securities? And as the interest rate environment dynamically changes, you want a manager to be able to make those adjustments. And the analogy I would give you is you have a race car going around a track, right? And as weather conditions on that track change, you want that race car to be able to pull over, and you want the MIT mechanics to be able to make adjustments on that car to maximize its performance based on the change in that weather, right? So if you don't have the whole opportunity set available to you, if you can't invest across the spectrum, you're just going around that track and going around that track and going around the track, no matter what the weather conditions change is. And your car is not optimized to run based on those changes. You want to be able to make the adjustments to the car to optimize it to get its best performance. And that's why you see these institutional managers really moving towards these multi-strategy funds where the manager can invest across the spectrum in an active way to help optimize the performance of that fund based on those changes I just articulated.
So, we're talking about sort of an alternative to traditional fixed income.
That's right.
What are institutions doing as an alternative to traditional equities?
It's interesting. So investing heavily in things like private equity, right? So private companies and the growth of those private companies before they go public. They're investing in things like credit, because credit is generally higher returning, and the expectation for equities is that returns are going to start to become muted over time, right? We also see a lot of money going into real estate. And again, more of an alternative to fixed income, because so much of a real estate return comes from equity, but they're also taking more risk in their real estate portfolios and tilting towards more growth strategies like core plus, value add, or development funds that are more growth oriented in their returns relative income returns. So we start to see investors say, okay, if I think my fixed income returns are going to become muted and I'm worried about inflation, I need assets in my portfolio that positively correlate to inflation. Those are things like credit, things like real estate. And as you know, across the real estate spectrum, you can take different levels of risk to achieve different return characteristics. So if I was looking for an alternative to traditional fixed income, I would invest in core real estate, which is predominantly income producing. If I was looking for an alternative to equities, I might invest in development or a heavy value add strategy where current income isn't really the goal or the investment objective. It's growing the value of my investment.
I think the takeaway with looking at where institutions are going is that as a retail investor, so not an institution, I might have to rethink kind of how I'm invested, right? The strategies that might have worked well for me the last 10 years, given that the economic environment's shifted quite substantially, I might need to shift my investments as well, right? And start to think a little bit outside the box and look for access to these types of institutional strategies that institutions have been, quite frankly, using for a very long period of time, but the retail investor hasn't necessarily had access to. Would you agree?
Yeah, I mean, we talk a lot about the 60-40. I mean,
Yeah.
how many investors walk into an advisor's office or do a little test online and come back as a moderate investor, and they get handed this 60-40 portfolio?
99 out of 100.
And you already alluded to the fact that if that 40%, in all likelihood, if you're investing in the U.S. aggregate bond index, so diversified across traditional fixed income in the U.S., you're getting basically nothing out of that 40%. And if you're transitioning into retirement, that's not going to move the needle for you.
Yeah. You're going to have to start spending down that 60%. And that's going to create big problems for you.
Yeah. So the idea is expand the opportunity set that you have available to you.
Yeah. Look at diversified return characteristics, and you can get those diversified return characteristics through alternative investments. And that's what institutions are doing. They're leaning more into parts of the market that are non-traditional in order to source those return characteristics that they're looking for that they can no longer get in traditional assets.
Fantastic.
Awesome. Thanks
Nick,
again.
Thanks again for coming.
Yeah,
Thanks for having
good
me.
to see you.
Appreciate the time.